Welcome back. It's good to have you back. We're wrapping up the course on governmental and not-for-profit accounting. We hope that you've enjoyed learning about this area. It's certainly a little bit different, the world of fund accounting, etc. Different from what you're used to. It's challenging, but like any other field, once you've worked in it a while, you get used to it, and it's a bit of second nature. I will say what's really fun about this area, what I've enjoyed over the years, is the fact that it combines the ability to serve the public with applying some of your technical skills. So if that appeals to you, this could be a career field for you, as I talked about with, I think, Chapter 11. Dr. Macbeth and I have been very pleased to have you in the course. Thank you for taking it. And if you have any kind of interest in the future, you have questions about the field or questions about the accounting, I hope you won't hesitate to contact either Dr. Macbeth or myself. We would be very happy to help you. Okay, so let's get into the lesson. We're now going to depart from the preparation of financial statements and moved into more of the evaluating the performance of financial reporting entities. This is part 2 of the chapter. Part 1 was covered by Dr. Macbeth. You should have a different, another video for that. So the learning objectives for this piece of the chapter: identify financial ratios commonly used to evaluate governments and not-for-profits and describe how they are calculated and interpreted. Ratios are a common method of evaluating financial performance, whether it's in government, not-for-profit, or the private sector. So you may have had some exposure to financial ratio analysis either in an accounting course or perhaps in a finance course. Also, what we're going to do is identify the elements of service efforts and accomplishments reporting and explain why governments and not-for-profit, explain why governments and not-for-profits report non-financial performance measures. This is an area that is somewhat new in the government sector. It is optional reporting, and whether you're talking about service efforts or you're talking about financial ratios, what oftentimes is important is to have some basis for comparing your entity's statistics to some other entity that is relatively comparable, to know how you're doing. It can be helpful to look at trends over time for your own organization to see if there's improvement or some deterioration in performance, but also seeing how others are doing. So for example, when I was at the city of Aurora, what we got involved in a benchmarking project of sorts, but in the end we didn't stay with it because we found that the other entities in the group were really not comparable to us. For example, there was the city of Aurora being in the Midwest being compared to Sunnyvale, California, which is in the West Coast. They don't have issues of snow removal and so on that we have here in the Midwest. So trying to get comparable benchmarks makes it more meaningful, but also it's challenging to get meaningful benchmarks. So along that same line, governments and not-for-profits come in different sizes. So what these ratios do is they tend to equalize the entities to a degree. That is comparing two financial statement elements so that it comes up with a ratio rather than an absolute number that can, to some extent, be compared across entities. It doesn't hold completely because there are differences between larger and smaller entities, but to a degree you get some comparability there. The amounts that we're going to be analyzing are derived from financial statement elements. So you look at the position statement, the flow statement, or the cash flow statement, you will be able to pull the numbers we're talking about almost exclusively from there. We'll get a little further on when we get into SEA, that is service efforts and accomplishments. It's a little bit different, but most things you can get from the financial statements. So as I say, you can do some benchmarking. You can also do some looking across time to see how your entity's improved or deteriorated. So let's talk first about some not-for-profit ratios. Now, these are a bit unique to not-for-profit organizations. You might find some similar sorts of ratios for private sector entities or governments, but some of this terminology is unique to not-for-profit. So one ratio that is sometimes used is the program expense ratio. So really what we're doing here in this ratio is taking it's a flow statement number, that is program service expenses, and dividing it by a larger, the catch-all outflow number from the flow statement. So basically what this does is this ratio talks about how much of an expense of the organization is dedicated to the core service delivery of the not-for-profit. Pretty simple ratio. We also have fundraising efficiency ratio. So in a not-for-profit, contribution revenue is typically a large number. So here we have that in the denominator. The question becomes, if you're spending money to raise those contributions, how much of the money that you're raising is being consumed by the fundraising exercise itself? So that's what this ratio shows you. It's a comparison of the expenses of fundraising to the actual amount generated. Another ratio typically used for not-for-profits is the working capital ratio. This is essentially a ratio that answers the question, how much of the net liquid resources are available to pay expenses. So when you take a look at what you've got in current assets, such as cash and investments, receivables and so on, and take away your immediately available bills, that would be accounts payable and so on, how much of that is left over to handle other overall expenses. So here what we have is we have in the numerator, you have two elements from the position statement, current assets minus current liabilities, and that's being compared with a number in the flow statement, that is total expenses. Okay, now let's venture into ratios for a government that might be applied to a state or local government. These are essentially sufficiency of equity ratios. They're looking at financial position. We've got one that we can look at for the economic resources measurement focus, essentially the longer term view of a government. And then you have one ratio that you can use to assess the equity of on a fund basis. Here we've used of the general fund. So that would be on a shorter term basis, looking at shorter term resources. So for the government-wide statements, to assess the capacity of the equity, you would take a look at the unrestricted net position. That is the piece of net position that is not restricted for certain purposes or otherwise set aside or matched with capital assets, then the unrestricted number, and compare that to the total expenses of the governmental entities. Now this is not business type activities, but governmental activities. Then you can also take a look at that short-term view. Here you would compare unassigned fund balance. That's the fund balance that's not set aside for any other sort of need, either designated by the governing board or designated by law. That is the money that's essentially free and clear. Putting that number in the numerator and dividing it by a denominator, which is on the outflows in the flow statement, that is total expenditures in other financial uses. So you've got a position statement number divided by a flow statement number. Now, there are some general benchmarks that tend to apply in certain types of government for that general fund balance, and you might also be able to find them for the government-wide statements. For example, there is a GFOA policy, a policy of the Government Finance Officers Association, that suggests that entities generally shouldn't have not less than 2 months of expenditures in fund balance. That's a bit of a minimum. At the College of DuPage, for our general fund, which is comprised of our education fund and our operations and maintenance fund, our policy is to have an unrestricted fund balance of 50%. what that does is it helps protect us against situations where we have a cash flow problem. Where that would most likely come up is if the state does not come through with giving us the money that they should be giving us as part of our funding structure. And that has happened. So there's certainly a need for these sorts of contingency funds in case something does not go according to plan. Another common ratio for governments is called the quick ratio. Basically what you're doing here is you're trying to make sure that you've got more current resources available than you have current obligations. So here you take cash in current investments. These are items that could be used to pay bills, and compare those to your current liabilities, such as accounts payable or payroll payable. So obviously this should be a number greater than 1. It reflects your ability to pay near-term bills. So here we have in the numerator 2 items from the position statement, and in the denominator you have 1 item that is pulled from the position statement. Also we have used in the government sector solvency or leverage ratios. This essentially talks about how much of the assets are financed with debt. So you certainly want a lower number rather than a higher number, but what we're comparing here are total liabilities minus deferred inflows, and you would compare that with total assets minus deferred inflows. So what you have here, these are all position statement items, And here what we're looking for, again, is a lower number if at all possible. Another solvency type of ratio is the debt coverage ratio. What we're doing here is trying to assess the extent to which operating cash is available to meet debt obligations. Now, what we're looking for here, this applies really most to enterprise type funds. That's a type of proprietary type fund for governments. And when you look at the items here, cash flows from operations, that's a financial statement subtotal from the statement of cash flows. And for governmental funds, we don't have a statement of cash flows, you'll recall. So that is in the numerator, the top, and then the denominator, we have the sum of interest paid plus principal, payments of principal. Both of those items are typically shown on the statement of cash flows. So you get both of those items, make a comparison. And of course, here what we're looking for is a higher number. So you've got more money that is available to pay interest and payments of principal. Another way to look at solvency, where in the prior slide we were looking at enterprise funds, here now we're looking at governmental type funds. Most specifically, what we're looking at is, if for governmental funds, we're looking at the principal and interest expenditure. You know, that's a term that applies to governmental funds. Principal and interest expenditure, and comparing that to the total expenditures of the general and debt service fund. So this gives you a feel for how much of a burden your debt service expenditures are vis-a-vis the overall expenditure. So obviously you want this number to be as low as possible rather than high, because you'd rather spend less on your debt if you can and spend that money on other things. So here what we're taking are 2 numbers that are both from the flow statement. Principal and interest expenditure, they may be aggregated or they could be separated. So that's the numerator. And in the denominator, what you have are total expenditures for the general and debt service funds. You may need to go to 2 different columns to get those numbers. Okay, up to this point, we've used all financial statement numbers. To get this next ratio, you may need to go elsewhere to get a number if you were to calculate this. Now, this ratio is the ability to pay, that is debt per capita. This is a number that you want as low as possible. And the numbers that you're getting, you get these from the government-wide statements, because you'll recall that governmental funds don't report long-term liabilities. And that's really what we're trying to get at here. So what you look at is total liabilities. Sometimes you might look at just long-term liabilities, but for the purposes of our text, total liabilities, and comparing that to population. So in other words, for every individual, what is that individual's share of the debt of the government? So the equalizer here is a bit of population. So population, where do you get that number from? If you're issuing a CAFR as a government, the population number will be shown in the statistical section of the CAFR. You may have noted that when you were doing your CAFR projects. But if the government is not issuing a CAFR, you will have to go to some other source in order to grab that number. That's a pretty obvious number that you could get from other sources that the government could even be on their website. Now, this is a very common number that is used to assess the debt burden. In fact, if the government is issuing bonds, general obligation bonds, those are bonds that are backed by the full faith and credit of the government, it's not unusual at all to see this sort of a ratio popping up somewhere in what is called the official statement. The official statement is essentially a prospectus on the bonds to be sold. So it gives the reader, the potential bond buyer, a feel for how much debt does this government already have. Another way to look at that same issue is to look at debt to assessed value of property. So you're still looking at those total liabilities, and as I say, you might just be looking at long-term liabilities in some instances, but total liabilities for the purposes of our text, and comparing that to the assessed value of property. So the assessed value of property is not directly the market value of the property. Assessed value of property is derived from a process that a government undertakes to determine the basis of property for taxation purposes. So this can vary from state to state, but just as an example, in Illinois, typically there's a valuation of property by a township or county assessor, and that is done not every year, but is done on a cycle, maybe every 3 or 4 years, and then that is the basis for that of taxation is somewhere in the neighborhood of oftentimes a third of what is the ultimate market value of the property. It's how it works here in Illinois. It works differently in other places. So with this ratio, you've got total liabilities from that government-wide statement, because total liabilities are not shown in the governmental funds, and you compare that to assessed value. So in the numerator of this fraction, you have an item from the government-wide position statement. Where do you get assessed value from? Well, if you're issuing a CAFR, that kind of information is going to be in the CAFR. But if you're not issuing a CAFR, you have to go to some other source to get it. It is public information. And if you're not getting it from an assessor or the government itself in some other way, you could look to another publication like a prior official statement for bonds. In fact, this kind of a ratio almost always appears in an official statement for bonds, because it's another way to look at how much debt an entity has. And in this case, you want this ratio to be as low as possible. Okay, that covers the basics of financial ratios. Now we'll spend a few minutes here talking about service efforts and accomplishments. So this is an area that is endorsed by the GASB, the Governmental Accounting Standards Board. However, it's not required. There's no required service efforts and accomplishments. But this whole area of SEA recognizes that the financial numbers don't always tell everything there is to know about how a government's doing. In fact, it may not tell even a majority of the picture. So SEA is a very valuable area, but it's difficult to do in terms of the time investment in getting all the numbers, because these are not numbers that are readily available unless you set up a system for generating them. It's not like your financial system always generates numbers for financial statements. This goes off into a bit of a different realm. Now, these are the basic types of SEA reporting. You might argue that some of these are better than others. Indeed, some are better than others. Some are more insightful than others. The most basic type of SEA reporting is an input measure. That is the resources that are dedicated to a problem. This would be something along the lines of tax revenues, numbers of teachers in a school district. These are not necessarily a reflection of performance. It just shows you basically what's going into the entity in terms of what it has to work with. Then you have output, which is the quantity of service provided, the quantity of service provided. So it's not talking about the quality or whether results are being achieved, it's what's the outputs, what's being generated by the entity. So it could be such thing as enrollment at an institution or the degrees conferred, in the sense that these are not necessarily clear reflections of how well the entity, the organization performs. They're just what it's generated. So just to give you maybe an illustration of why this might not be the best level of insight, even degrees conferred. Just because someone gets a degree, that does not necessarily mean that they're skilled to do a certain task. That starts to speak more to this next item, and that is outcome. These are measures that reflect the extent to which results are achieved or needs are satisfied. So we've been talking a bit here about the educational environment. Reflections of outcome would be standardized test scores that are favorable, or accreditation results on a college. That would reflect outcome, how well they're actually doing what the business of the institution. Now, you can take some of these numbers and put them into a ratio just like you constructed financial ratios. And they can also lend some insights. An efficiency measure is a ratio of costs or inputs to output measures. So you take a couple of the items that we just talked about and compare them. So what might that look like? So for an efficiency ratio, you have a ratio of number of teachers in the numerator over number of degrees conferred. So that gives you kind of how many degrees are being generated by whatever number of teachers you've gotten, and does that change over the year, and how does that compare to other institutions? Or arguably a better measure is a cost outcome measure, which takes those same types of inputs and compares them to outcomes. So if you were to take that same number of teachers in the numerator and compare them to, say, some kind of standardized test score measure in the denominator, that would give you input as to how many teachers are needed to generate whatever the outcome is. And as you add more teachers, does the outcome get better? One might hope so. So that would be a measure that you could use to assess an institution of higher education, perhaps, public higher education, perhaps. So we do have a prompt question for this chapter, and the prompt question is basically to choose one ratio discussed in the chapter or in this lecture, select just one ratio, explain how to calculate it, and explain its significance. So also talk about where the numbers come from to generate the ratio. So with respect to that last point, if you were going to do the government-wide financial position ratio, you would need to explain that the numerator comes from the statement of net position, and the denominator comes from the statement of net activities. That concludes our lecture for today, and this also wraps up the course. Again, thank you for taking the course. We hope you found it informative, and we look forward to having you in another accounting class at the College of DuPage. Thank you.